The sell-off continues. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Walmart in the red. The world's largest retailer misses profit expectations for the first time in 3 years. President Trump escalates his pressure campaign on the Fed as the annual Jackson Hole Symposium kicks off. And we're getting closer. The EU and the U.S. take steps to lower tariffs on many products, including Lamborghinis, which is important to me.
I know, near and dear to your heart. But speaking of getting closer, Boeing higher as it moves closer to finalizing a deal with China to sell as many as 500 aircraft. This is according to people familiar with the matter. Now, this is contingent on simmering trade tensions between the U.S. and China getting resolved. You can see that shares currently higher by about 1.8% pre-market.
And maybe we'll hear about an export tax on those
exciting
planes as well. Walmart shares falling after profit missed expectations, as I said, for the first time in 3 years. The problem is a rise in insurance claims, legal charges, and restructuring costs. Despite the rare profit miss, Walmart raised its full year sales guidance and isn't too worried about price increases, Katie.
It's interesting, even with that guidance boost, we're seeing shares lower right now. So let's dig a little bit more into Walmart with Bloomberg's Emily Cohen. She leads our coverage of the U.S. consumer. So when it comes to the profit miss, certainly turning a lot of eyeballs here, was it just about these higher than expected costs?
So I think it's important to keep in mind this is Walmart. Expectations are really high. This is their first profit miss in 3 years. So yeah, this is mostly due to, they're saying it's mostly due to insurance claims, legal charges, restructuring costs that should abate later in the year.
And they already were up like 14% year to date, so they're still doing better than the S&P, and over the last 5 years up 150%. The company has done very well. What's the outlook?
When it comes to the consumer, I think we're still seeing resilience here, despite costs going up. Despite prices going up 1% in the quarter, still seeing gains there, especially from higher income households, which is what we've seen throughout the course of the past year. Shoppers trading down to Walmart, gaining share there. Walmart has a huge advantage here in its size and its scale and its relationship to its vendors. It can keep prices low despite costs going up.
I should clarify that when I say they're up 150% over 5 years, I'm talking about on a total return basis.
Thank you. That matters.
Yeah, it does, because they have, I think, like a 23-cent dividend right now, 23.5 cents. Emily Cohen, thank you so much.
Thank you
for joining us. Emily covers retailers for us. Now, the U.S. and the European Union have taken steps to formalize their trade pact. The plan could reduce tariffs on products like automobiles and generic pharmaceuticals. If the deal fully goes through, most of those rates will be capped at a flat 15%, except for the metals tariffs. The U.S. is committing to lower most favored nation tariffs to a slew of other European products like aircraft parts. The EU's trade commissioner spoke earlier in Brussels.
This is not the end. It's the beginning. This framework is the first step, one that can grow over time to cover more sectors, improve market access, and strengthen our economic ties even further.
One executive who may be cheering the news is Lamborghini CEO Stefan Winkelmann. He spoke to Katie and myself last Friday and said it would be helpful for the current level of autos duties to fall even lower or wiped out entirely.
We have not the tariffs at 15% right now, but they are 27.5. For sure, we hope that they're going down to 15. That would be a solution which we can live with. But we are for free trade, so the best would be not to have tariffs at all around the globe.
And staying on trade, Boeing is heading closer towards finalizing a deal with China to sell as many as 500 aircraft. You can see that shares are rising on that news. Let's bring in Sid Phillip. He is Bloomberg's chief correspondent for global aviation. He joins us now. And Sid, you were on that byline. I want to talk about this line in your story that this is contingent on the two nations diffusing the trade hostilities that hark back to Trump's first term in office. Sid, that feels like a pretty big if.
It is a pretty big if, and I mean, obviously, aircraft deals have become a huge part of Trump's diplomacy efforts. And so every trade deal that he struck, we've seen an aircraft component in it. And so this would also be one of those deals. Only thing, this would be a far bigger defining sort of part of any deal. And for Chinese airlines, they need the capacity, they need the lift, they need to be able to upgrade their fleet, they need to be able to to grow their fleets. And so they need the capacity, and COMAC is still not producing planes at a large enough scale for China to be sort of independent. So they are dependent on Airbus and Boeing. And for Boeing, China is a huge part of the market. There were about a quarter of their total sales in the sort of pre-trade hostilities, and now they're about 10% of the backlog. So essentially for Boeing to sort of go back to those levels, they need to get China on board. And so a trade deal which is sort of brings in a big aircraft purchase is a win-win for both sides. It sort of signals to the US government that China is willing to buy US planes, and for the Chinese carriers, it can sort of allow them to look at expansion and fleet replacement, which they need.
I wonder about, transportation is hugely important to economic growth. They need planes to be able to do business, and Boeing is a huge part of U.S. national security. Are we going to see any export taxes, the likes of which we saw with NVIDIA or AMD, or do we not know yet?
We don't know yet. I mean, obviously, we will see what the fine print of that deal is and what the actual sort of intricacies are. We still don't know what the composition of the deal is, what the airlines are asking for, because what we understand is that the Chinese government is currently asking the airlines what sort of capacity they need, what sort of aircraft they need, whether they need narrow bodies, wide bodies. And so we're still working on getting on those details. But as we get closer to the finish line, we might be able to see more of what the specifics of the deal would be.
All right, Sid, I trust you'll be breaking that news for us. Sid Phillip there, our chief global aviation correspondent. Let's get to tech now, because Palantir's six-session losing streak has wiped out $73 billion in market value. That drop has given short sellers more than $1.6 billion in profit, according to data from S3 Partners. Bloomberg Tech's Caroline Hyde joins us to discuss. So we knew, Caroline, this company had been seen as sort of the poster child of frothy valuations, right? 100 times sales, multiple hundreds of times profit expectations, and it's come down significantly.
All the way to 199 times future profit is the current valuation. I mean, we've seen a rectification, and you just put it there, Matt. $73 billion of market cap has been eroded over the last 6 trading days. We could just edge a little bit higher in the beginning of trade today, but I think more broadly, we have been seeing a reality check on just general artificial intelligence hype. There's been a myriad of perhaps straws that broke the camel's back. Some pointed to the MIT study, of course, the worry about the fact that all of these companies are using generative AI, but only 5% are getting any sort of productivity or profitability gain. Others are just talking to just the fact that you've got the macro picture to worry about this week and what Jay Powell is going to say. But when you have the likes of Microsoft, NVIDIA, other key bellwether names that have been pressured, no wonder the retail favorite, no wonder Palantir comes under pressure, and you do see a whack to the stock. But it is interesting that, as you say, still, it trades at very elevated levels versus future sales and profitability. And I think fundamentally people don't think the picture has shifted. It's only back in beginning of August, we had the earnings call from Alex Karp. What was he saying? They'd bent those naysayers into submission, and he thought that finally we were getting some sort of, the skeptics were fewer and further between, but now some of those shorts are finally making a little bit of money.
Yeah, it feels like just asking for trouble saying that. But I'm glad you put it in context of what we're seeing in the tech sector broadly, because certainly if you're the highest flyer, you have more room to fall. I do want to talk a little bit about Meta. We've spent hours on this show talking about Meta's expensive hires when it comes to their AI superintelligence team. But now we have Meta, a spokesperson saying in an X post that it's temporarily paused some hiring in that unit. What is going on exactly?
Well, I also wonder whether that's clever timing too, because some of the anxiety had come in that these companies are just spending huge amounts in terms of capital expenditure. They want to see that. They want to see the infrastructure spend. They want to see the right talent. But when you hit 50 or so of the creme de la creme R&D research developers out there that you've taken from OpenAI and taken from Google, maybe investors would like to see a slight pause and maybe hints at money coming back to them at some point, whether it's in terms of buybacks and the like. But more broadly, I think Meta's got its AI house in order where it wants it right now. They've decided to put, of course, we've got Alexandra Wang there leading the charge now for the superintelligence team. They're focusing on 4 key areas, which I'm sure you talked through. The fact that you're still getting the LLM focus, you're still getting the focus on AI research for the longer term, but then you're getting the products. You're getting that led by Nat Freeman, who used to lead GitHub. He's going to be thinking about how you put all this research into actual productivity gains and communication tools. And then you've got the last bit, which is infrastructure. But maybe they just need to hit the pause button, help these people work together. And actually, they're saying that you can't transition within the team either. So maybe this is quite a clever PR signal.
There's been a lot of reorganization in that team, reportedly, so I'm not sure if they really have their strategy fully mapped out yet. I'm very much looking forward to your program today because you have so much news beyond what we've spoken about. Google, Databricks.
$100 billion valuation. I mean, you talk about froth.
OpenAI. I mean, there's so much to talk about in tech. So Caroline will be hosting the Bloomberg Tech Show, I believe, along with Ed Ludlow today at 11. It's one.
Off, man.
He's still off?
If you want to come on vacation.
He's still off. He's still off. So I'm sure she'll do a great job handling it herself, and we will watch from 11 to noon. Should we check on futures?
Because I think we should.
I'll tell you what, when I came in this morning, tech, like NASDAQ futures were up.
Well, that feels like a long time ago because now they are firmly in the red along with the S&P 500. Both of those indexes down about 0.3%, continuing the losses that we've seen on both of those indexes this week. We're looking actually at a 5th straight day of losses. We'll see what will actually churn things around. But I do want to point out the small caps as well, taking a beating. The Russell 2000 currently off about 0.6%. It's hard to put too much stock into what's happening in late August when it comes to the stock market. But we know that we have the big event tomorrow.
Right. Well, late August. The thing is, as we see these losses, we also see expectations for a Fed rate cut creeping lower. We're still looking at 80% on WIRP, but
it was certainly a lot higher a week ago, 2 days ago.
Yeah, a week ago it was over 100. We were thinking that the risk was a 50 basis point cut, and it looks like now the risk is none. Coming up, we're live, speaking of, from Jackson Hole, Wyoming, as pressure builds on the Fed. That's next. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. We've been reporting all week about the Dayforce sale, and now it's official. Thoma Bravo will buy the HR software provider for $12.3 billion. You can find out more about the deal on Bloomberg Tech today when Danny Berger and Caroline Hyde interview Thoma Bravo managing partner Holden Spott. Now, Gilead Sciences is falling after a report that CVS Health is declining to add the biotech's new HIV prevention drug from its commercial plans. It's the largest U.S. pharmacy benefits manager, CVS, and it said the decision is based on clinical, financial, and regulatory factors, so like everything. Rent the Runway will hand over a controlling stake in the company as part of a plan to cut debt after the pandemic pushed the firm to the brink of bankruptcy. The deal with lender Aranda Principal Strategies will wipe away more than $240 million of debt from Rent the Runway's balance sheet, Katie.
All right, let's turn to the Fed right now because Bloomberg caught up with Kansas City Fed President Jeff Schmidt on the sidelines of the Jackson Hole Symposium.
I think that's where you're seeing a lot of the debate now is, where's your lean? Is it do you believe things are too restrictive on the policy rate side or not? I think they're modestly restrictive. I'm still trying to find ways what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
Bloomberg surveillance co-host Lisa Abramowitz joins us now from Jackson Hole. Lisa, really excited for the program tomorrow morning. So the theme of this year's event is labor markets in transition, demographics, productivity, and macroeconomic policy. And there's certainly plenty to talk about.
Sure. And in another year, maybe everyone would be lined up to talk about artificial intelligence and what that will do to the labor market. That is going to be in the background this year, a very different type of Jackson Hole with all of the potential political noise around the Fed Board of Governors, and a real question here of how it will be addressed. Will Fed Chair Jay Powell directly deal with the elephant in the room, the sort of question of how much interference this administration is looking to have with the Board of Governors, or is he going to leave it to Christine Lagarde, the head of the ECB, or Andrew Bailey, the head of the Bank of England? A real question here also how they deal with inflation, what they're going to do with respect to the fact that we've seen higher than 2% inflation for the past 4 years. Do they shift their target to something that addresses maybe a higher inflation rate, or do they reiterate their concern? How do they deal with stagflation light? These are all of the questions at the same time that, yes, maybe the headline theme is artificial intelligence, demographics, immigration, all these sort of big academic thought pieces. That's not the reason why there's so many journalists here and TV trucks.
Yeah, I mean, inflation is also headed higher, right? Not only is it 60% above their target, but it's going in the wrong direction. If you look at the core PCE, the core CPI, and the core PPI is even higher. Maybe next year, the summit will be about the effects of tariffs and monetary policy on inflation. Ken Rogoff told us a couple of days ago that he thinks it's going to be headed back up and the Fed will have to start raising rates next year. What's the likelihood that Powell says he's really worried about cutting into an inflationary or inflated economy?
This is actually a really big consideration, especially after yesterday when we got the minutes from the last Fed meeting that showed that inflation very much is front and center for them. We're seeing that with respect to what we got today from the Philly survey, as well as Walmart earnings, showing that they're going to keep raising prices, albeit trying to tamp down as much of those as possible in order to continue to see the same kind of consumer demand. But look, we've seen inflation, core PCE, has been above 2% since 2021. Materially so. If they choose to do some sort of average targeting of inflation between 2 and 2.5%, et cetera, that seems to be in the range of where they were looking maybe back in 2020 when they last did their framework review. But times have changed. We are in a newly inflationary moment, and how much tariffs really add to that is a really key question. Do we expect Fed Chair Jay Powell to start talking about what tariffs will do? Hard to say. It seems like a little bit of a political hornet's nest. Nonetheless, they have to address how this sort of supply-demand balance really gets shaken out and how much they feel willing to address some sort of inflationary spike. Are they going to look through it and keep rates where they are, or are they willing to raise rates again at some point to combat that? Look, this is a huge issue, and you're going to see a lot of discussion around it. We heard from this morning from Raphael Bostic of the Atlanta Fed. He still is in line to only cut rates once, which seems at odds with markets that seem to be pricing in at least 2 rate cuts.
All right, Lisa, really looking forward to the programming tomorrow morning. That is Bloomberg Surveillance co-host Lisa Abramowitz. Don't miss our Jackson Hole Surveillance special. It kicks off tomorrow at 9 a.m. Eastern. Jerome Powell himself speaks at 10 a.m. Eastern. And you think back to previous Jackson Hole symposiums with Fed Chair Jerome Powell at the helm. He's usually used the stage to make policy pronouncements. I'm thinking about last year, for example. He said that the time has come for rate cuts. Then they delivered a 50 basis point cut. I don't know if anyone's expecting a repeat performance there.
No, and to your point, yesterday, you reminded us that we saw the 10-year yield rise.
Yes.
Right, as they were doing that. So it's a real question, I think, for this administration as well. Yeah. Do cuts for the overnight rates necessarily lead to lower rates in the longer part of the curve? And that's the kind of thing that Lisa and John talk about all day long in surveillance. So you can catch more on their special tomorrow. Obviously, we're going to be focused completely on Jackson Hole as that speech starts at 10 a.m. And I'm actually going to anchor surveillance on Bloomberg Radio, so I'm kind of excited. Me and Paul, because Tom's out there with Lisa.
I'm excited for you. You'll also be in the 5 a.m. hour. I will be completely off air tomorrow, so I'm excited for me too. But I'm excited for our guest joining us up next. Chris Verrone from Strategist joins us as investors get cautious ahead of Powell's speech tomorrow. This is Open Interest. time to buy the dip again. That is according to the trading desk over at Goldman Sachs, telling clients that losses in momentum stocks may present a dip buying opportunity so long as tech earnings next week, including NVIDIA, but really it's just NVIDIA, drive a prolonged AI sell-off. Joining us at the desk is Chris Verrone. He is partner and chief market strategist at Strategas. That is a Baird company. And Chris, you think about the sell-off that's been developing in the S&P 500. We're looking at 5 or 6 days of losses on your big benchmark. What's your opinion? Is this a time to step into those losses and try to catch the knife?
Well, I think the good news is it's been very rotational under the surface. I mean, most stocks have actually been up the last several days, even as some of the big AI darlings have been hit here. Now, I would say in terms of the index itself, maybe talk to me in 6 weeks. I think it's the last week of August. I think we're in, as we know, one of the weaker seasonal periods of the calendar. This is really not the time of the year to be chasing momentum. I think we'll get a better, I think we'll get a better chance to, quote, buy the dip, say late September, early October. I think worst case, you're looking at 6150, maybe 6200 on the S&P. But remember, as the big stocks have come in, look at all the durables, the economic cyclicals actually starting to turn back up. Home building, autos. That seems like it's still a pretty constructive economic story being told.
So this seems to be these drops of the last few days. They haven't been big. I don't think they've been on huge volume. We've seen a little bit more at the open. But it coincides with a higher risk of no cut. Now, there's still an 80% chance of a cut in September, but do you see that as a big risk, and is that a problem for stocks if they don't?
Well, we sit here on the eve of Jackson Hole, and we always joke kind of who needs Jackson Hole when you have the two-year yield. And the two-year yield is telling you you're going to get 75 basis points of cuts here over some period of time. I mean, the two-year yield is called 375 at the moment. We know where Fed funds is. So I think it would be silly if the Fed didn't go in September. And I don't think this is about getting easy. This is about getting back to neutral. And my suspicion is that is what some of those rate-sensitive corners of the market are really starting to inflect on.
All right, Chris, we are just getting started. You're sticking with us through the opening bell. That is up next. Take a look at this setup as we count down to the ringing. You can see it doesn't look too good, but we'll bring you through all the opening action up next. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at yet another down day on stocks. S&P has been off basically 5 days in a row. Right now, futures are down 1/3%. NASDAQ futures also. And when I came in at like 3, they were up. So we thought there'd be a recovery, and there hasn't been one. Goldman Sachs says buy the dip. People aren't doing it yet. Ringing the bell at the New York Stock Exchange, Disney, ESPN, as Chris points out, Troy Aikman there, which is pretty exciting. And this whole story, I think, is pretty cool because as people are able to actually watch live sports on the ESPN Plus apps, they'll be able to totally cancel cable. They don't need Fubo. They don't need DAZN anymore. It's not cool for those guys, obviously, but for maybe us. Origin is a SPAC. Who knows what they'll do? Something probably great with that money. And
okay.
I don't know. SPACs just tend to like dive, right?
Well,
do you ever look at a SPAC chart that's been awesome?
In 2021, it was a different story, and it feels like we're getting some of that frothiness back in the market. We'll see what happens with Origin. But let's talk about Boeing. Shares unchanged, which is interesting because it was higher pre-market as it moves closer to finalizing a deal with China to sell as many as 500 aircraft. That is according to people familiar with the matter. This would be contingent on simmering trade tensions between the U.S. and China. Specifically, those trade tensions may be cooling down a little bit. As we were talking about with Sid Phillip a little bit earlier, Matt, that is a big if, and that might be why you're seeing Boeing kind of lose some of the momentum it was building pre-market.
Waiting for that export tax announcement to come out. Walmart shares falling after profit missed expectations due to a rise in insurance claims, legal charges, and restructuring costs. Despite the rare miss, Walmart raised its sales guidance. It had been up almost 14% year to date. It's been up with total return 150% over the past 5 years, so it hasn't done poorly, and maybe this is some profit taking. We're back here with Chris Verrone, partner and chief market strategist at Strategas, a Baird company. And Chris, what do you think about the impact of tariffs? Like, we keep waiting for it to show up in the numbers. It hasn't yet, but I guess now economists are saying end of third, beginning of fourth quarter.
I mean, first it was the end of the second quarter, then the end of the third quarter. Now they're talking about 2026. We always concede in our work that the market is far smarter than we'll ever be. And when I look at how the consumer discretionary stocks on balance have responded over the last 6, 8, 10 weeks, I think it's really encouraging that the market has looked through what potential problems may be out there. Discretionary equally weighted is at 5-year relative highs versus the S&P, so strong as it's been versus the index in 5 years. You've seen the index itself break out on a price basis. Internally, we have some of the best participation within discretionary that we've seen in years. So if I'm going to take the market's word, I think the consumer's in pretty decent condition here. Whether that's a response to future rate cuts, whether that's a response just to this resiliency that's been so clear over the last number of years, we'll see in time. But I think the consumer is still in a decent place here.
Well, on the topic of tariffs, let's talk a little bit more about trade, because one of the big headlines this morning is that the U.S. and the European Union, they're taking steps to formalize their trade pact. You're not seeing really any reaction in the market. It seems like, to your point, the market is just looking through some of these trade negotiations in particular. Is that just because we're not talking about China, or because we've just grown numb to the topic?
Well, I think what's curious, when you look at Europe in particular, even kind of during the heightened moments of stress over recent months, the European banks never went down. So if we're going to use the European banks as some barometer for how the market perceives the state of relations, I think the response there has been pretty telling. I would also note Moeller-Maersk, the largest shipping bellwether in the world, has broken out here. So if we're thinking about messages on global shipping and global growth, constructive message there. Turning to Asia, you've seen Chinese 10-year yields go up. You've seen the Chinese credit impulse turn up. So could we make a case that global growth is actually re-accelerating here? Look at the Japanese chemicals, the Japanese autos, the Chinese tech stocks.
Look at liquidity. Look at M2.
There's a story coming together here that I think the consensus is going to have to move to, that the slowdown happened. The slowdown's over. And the re-acceleration of 2026 might be the untold story.
So, I mean, you're chief market strategist, not just focused on what's going on in the U.S. When you look around, do you see pockets, regions that are more interesting?
I mean, you have a raging bull market in Japan that gets absolutely no respect. I mean, Nikkei spent the last 2 years chopping around, has decisively made new highs here, but look at the leadership coming from that part of the world. You've seen the autos turn up. You've seen the Japanese kind of tech and software and comm services all take the baton of leadership, and these Japanese banks have just continued to work through it all. So, you know, there's all this attention on Europe. There's certainly been attention on China. The Japan bull market is the most untold one. And, you know, I think the hesitancy that investors have had is they see what JGBs have done, they see what the yen has done, and they can't fathom how the market could perceive that in anything but a bearish light. But the market's telling you a different story over there, and I want to respect it.
Yeah, that's a really interesting point. It is a very quiet bull market because we don't talk about it at all.
Ever.
Let's talk a little bit more about other parts of the market, though, and let's talk about other asset classes, because we were just talking about the example of last year when you had the Fed deliver that 50 basis point cut and you saw 10-year yields shoot higher. Do you think that we're setting up for a repeat here, or what is going on at the long end?
You know, I think when you talk about the long end and you put it in context of what's happened this year, it's also been another story of waiting, and hey, nothing happens, right? First it was the tax bill, then it was the tariffs. Any of these were supposed to break the long end out, and it never happened. You know where the long end is breaking out? In Germany, right? So the one area without a tax bill, without a big, that's where you've seen the big move on the long end. German 30-year yields through about 3.25, making cycle highs here, not in the U.S. So very important distinction there between what we're seeing in European yields and what we're seeing in U.S. yields.
So if you had a client come to you with $1 million burning a hole in her pocket and said, like, I want to put it all on red 22. Is there something that you're excited about? Something you're sitting around with your scotch at the end of the day and thinking, God, I love this investment thesis.
That sounds nice. Listen, I think when you look at the landscape of the world here, I want to lean into areas of the market that I perceive to be unappreciated but working. And that's always the best combination in this, where you have a very dismissive class of people about it, yet strength. And I think Japan fits that bill. I think consumer discretionary fits that bill here as well. I'll tell you what does not fit that bill. There's still so much enthusiasm about gold and precious metals. Gold hasn't made a dollar of progress since the April blow-off, I think April 15th, April 17th. And that's against the backdrop of Middle East conflict, Ukraine, Russia, tax bill, tariffs. Gold has been dead money for 4 months. I think it's finished here. People still love it. We don't see it.
That is also a great point. I'm looking at the chart of gold right now, and you're right. You see the steady climb higher, and then we've just been treading water for several months now.
You know what's been unique? The gold bull market really commenced with what I would say is maybe the weaponization of dollar back at the start of the Ukraine-Russia war in early 22. So I think gold's indifference here, and frankly, I suspect in time, gold's weakness is another tell that, hey, we're getting closer to peace there. I think the weakness in the European defense companies reflects that as well. Look at Rheinmetall, look at BAE Systems, look at Foulkes in France. There seems to be a story coming together that the market's pretty optimistic about this getting done.
All right, Chris, great to get some time with you. That is Chris Verrone of Strategas. That is a Baird company. Meanwhile, let's get a check on this market. We're about 7 minutes into the Thursday session. The S&P 500 continuing to sell off here, down for a fifth day, only down about 0.3% right now. But I want to highlight the breadth that we're seeing to the downside. You have fewer than 100 names in the green right now, more than 400 nursing losses. Up at the top, this certainly helps. You have NVIDIA higher by about 0.7%. We've actually seen it in the other column for most of this week, but NVIDIA rising a little bit. Same story when you take a look at Alphabet, looking at gains of about 1%. That is trying to lift this market, but take a look at some of the weights. Walmart reporting earnings, that rare profit miss. That's good for a 4% decline. That is your biggest loser on the index right now. But you also have Amazon, Meta, Costco, et cetera, also weighing down the index. And you add it all together, definitely more losers than gainers. And that's going to be true at the sector level as well. The only sector in the green right now is communication services. That's pretty much tech in disguise, only looking at a gain of about 0.1%, and then it just gets worse from there. Currently, your biggest losers are real estate, financials, and consumer staples. Matt Miller down by about 1.3%.
It is especially ugly from an industry group point of view. That does not look good. All right,
no.
And I note that the Mag 7 index is also unched right now, so not making a lot of forward progress. Coming up, Walmart falls after the world's largest retailer reported its first profit miss since May of 2022. We'll break down the earnings call, which just happened with Analyst. Next, this is Open Interest.
Welcome back to Open Interest. Let's take a look at the sell-off right now. The S&P 500 down by 3 to 0.4%. Similar magnitude when you take a look at the NASDAQ 100. The small caps taking a beating, down about 0.5%. This would be the fifth straight day of losses for the S&P 500 should this hold. A lot of questions whether this is just August trading, whether there's something more fundamental going on. But at least for right now, the S&P 500 down another day. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Coty is getting cut over at Citi after the beauty maker forecasted a steep decline in sales because of falling demand. Citi says that these challenges will last for at least another 2 quarters. Coty shares down 21%, total wipeout there. And finally, we have Hewlett-Packard Enterprise getting raised to a buy over at Morgan Stanley. The analyst says that the recently closed Juniper deal will have a positive impact on earnings. Finally, some good news. Those shares up about 2.2%, Matt.
All right, interesting upgrades and downgrades there. I was just looking through Coty's perfume portfolio here.
Anything you like?
Well, apparently like 70 different brands: Hugo Boss, Gucci, Davidoff, Bottega Veneta, Calvin Klein, Marc Jacobs, but also Glow by J.Lo.
I just mix them all together, so.
Lady Gaga Fame, a unisex perfume. Released by House Laboratories in partnership with Coty. Let's turn back to the world's largest retailer, where you can no doubt buy all of these things. Walmart shares falling after profit missed expectations for the first time in 3 years, overshadowing higher sales and really the outlook. Joining us now to talk about this is Andrea Felstead, a Bloomberg opinion columnist who's been covering consumer goods and the retail industry for years for us here at Bloomberg. And Andrea, this has been a company that's, the stock has been successful, right? Until today, it was up 13, 14% year to date. Over the last 5 years, it was up 150% if you reinvested your dividends. Why such a sell-off today?
It's really because they raised their sales forecast, but they've left that profit forecast unchanged. And the profit miss was really about higher legal costs and some restructuring costs. But the outturn has worried investors that the great run that Walmart's had may be coming to the end, and maybe there are some cracks in what has been a really great story over the last few years.
But the thing is, who can take share from Walmart? And I especially go to the grocery business. They have a massive grocery business. Okay, maybe Amazon could chip away at that, but it seems like Walmart is just really dominant.
Well, there's a very interesting competitor coming from Europe for Walmart, which everyone really should keep an eye on, and that's Aldi. Aldi's really been expanding in the US. They have really low prices. They've been getting a lot of traffic, a lot of footfall. Now, about a decade ago in the UK, Tesco here was very dominant. And it really wasn't as aware of Aldi as it should have been. And Aldi really took a lot of sales. And that is a real worry for the US. So Walmart really, it might be dominant. It's got Amazon, but it really has to stay on its toes with Aldi. It can't afford to let those low prices in its DNA slip.
Yeah, that's for sure. And you're seeing more Aldis pop up around the U.S., so it's a good point and something to keep an eye on. I do want to get your opinion on Target. Of course, we got the news yesterday that they're appointing long-serving executive Michael Fidelki to succeed as CEO here. He is a company insider. And Andrea, you wrote about how really he's taking over a company that's confronting an identity crisis right now.
Exactly. I think his turnaround that he's got to do is much harder than the one that Brian Cornell did. He had to fix the nuts and bolts, which Michael Fidelka has to do too. But he's really got to decide what Target stands for. It's had some real, flip-flopping in its identity with the Pride issue a couple of years ago, backtracking on DEI, and Target really put every kind of inclusivity at the heart of its strategy. So that's really stung a lot of customers. He's really got to, fight back and, reclaim Target's identity and win the trust of customers, at the same time fighting against Walmart, which is really going after, it was saying today it's growing with wealthy customers. It's really going after those more affluent consumers who typically shopped at Target.
Wait, do you think they need to kind of take a stand then if Target is more the left-leaning soccer moms and Walmart is more of the Trumpier country shoppers? Should they do?
I think they should. I think they should reassert their identity in the way they always had that. They were always known for being very inclusive with customers, and that slightly more affluent shopper base means their customers can afford to decide where they shop, whereas I think Walmart's customers typically have been driven by low prices, that need for value. When you think about Costco, which has stuck to its principles, it's always put things like higher staff wages at the heart of its strategy. It's actually been gaining shoppers and gaining footfall. So I think there's a real lesson here for Target.
All right, Andrea, thanks so much for joining us. Andrea Felsted there, joining us from Bloomberg Opinion. You can check out her work by typing OPIN-GO on the Bloomberg terminal. You can find her on Bloomberg.com as well. We're going to have more on retail in the next hour. TD Cowen analyst Oliver Chen joins us. He has a buy rating on Walmart stock. We're going to talk Walmart with him, maybe dig in a little TGT as well. Coming up, OpenAI may soon make its extensive knowledge on AI infrastructure a service for other firms. They're going to spend trillions of dollars beefing up the AI infrastructure. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at what stocks are doing. Continued losses on the equity indexes. S&P 500 down another third of 1%, 63.72. Still not terribly low, but we're coming off of almost 6,500. Nasdaq 100 down a third of a percent at 23,172. We do have the dollar rising here. The Bloomberg U.S. dollar index is up, and NVIDIA also putting up some gains. Maybe a little bit of a bounce after some drops there. Meta, Facebook is down as they kind of freeze hiring. They've reorganized their superintelligence unit like 4 times in the last 6 months, according to reports. Walmart is off a whopping 5%. We just talked about that. Boeing getting a boost after it sells 500 planes, or agrees to sell 500 planes in China. Intel down a little bit. This one is interesting. It has continued to fall, and along with the rest of the tech sector, really reducing its valuation to only 199 times future earnings. So, Katie, I guess investors not buying the dip today.
Yeah, it's a real bargain there. Let's talk about OpenAI, though, because OpenAI's CFO is outlining a new strategy for the firm. Sarah Fryer says that OpenAI is considering helping other businesses tap into the data centers and physical infrastructure needed for artificial intelligence. Bloomberg Intelligence head of global tech research Mandeep Singh is back in studio. He joins us now. Mandeep, tell us what's in it for OpenAI. Why do they want to do this?
Well, right now what we are seeing is OpenAI has the best models when it comes to deploying generative AI. And with reasoning, that's the big shift this year. What you're seeing is the compute demand has been off the charts. In fact, OpenAI has signed deals with Google and CoreWeave. So remember, OpenAI had an exclusive partnership with Microsoft. Everything was deployed on Microsoft, but now they are leasing infrastructure from the likes of CoreWeave and Google. And that just goes to show they just can't meet the demand. It's like NVIDIA's chips. Similarly, everyone wants to use OpenAI's models, and they see that demand. They want to get into infrastructure. I just don't know if that's the right thing to do. I mean, everyone wants to vertically integrate when it comes to tech. But in this case, OpenAI is also burning a lot of cash with their compute. I think Microsoft said they are burning $3 billion per quarter.
Well, they're not there yet, right? I mean, Sam Altman said they're going to need to spend trillions on compute. And as they do that, as they build up so much experience in data center operation, I guess Sarah Fryer's point was, now we know everything about it. After we get to a place where we have enough for ourselves, maybe we'll help other people get into the business as well.
So in the enterprise world, I mean, in theory, it sounds good, but you have to remember the reason why hyperscalers are so dominant is because they have all the legacy workloads from the companies. The databases reside around hyperscaler systems. So to build a new compute infrastructure, yes, you can have the GPUs, you can have the models, but the data on which you want to run AI still resides on those hyperscalers. So it's very hard to establish yourself as a new player. NVIDIA actually has mentioned about that as well. So clearly, I think there are a lot of other players who want to get into infrastructure business, but it's hard because the hyperscalers have such a strong hold in terms of the existing workloads that are running on those systems.
Google has a ton of data, right? And they're one of those hyperscalers you're talking about. They came out with a bunch of products today, not AI stuff necessarily, but I guess they're hoping that that data, that their models, that Gemini is going to make people switch out of the wealthy people switch out of the Apple infrastructure and finally buy a Google phone. I can't even remember what they call their phones.
Pixel.
Pixel, there you go. Google watches. They're going to get Katie to give up her Garmin. and they want earbuds they have out. Does that look like a successful strategy to you? Has it ever really worked out for Google?
I mean, for Google, it's always about their ecosystem, and Android is what they're really focused on.
Right.
I don't think they're really leaning into a hardware strategy where Pixel will, sell more units than an iPhone. That's not going to happen. I don't think the company is betting on it. But for them, it's about Android being a better operating system than iOS and integrating AI into wearables. That's where all the demos were focused on, that even in your earbuds,
it's yet to come.
You can run AI partially, and that will
Dude,
make
even you gave up your Meta glasses.
That's
so
true.
Mandeep Singh there runs our tech coverage for Bloomberg Intelligence. Liz Ann Sonders joins us in the next hour. This is Bloomberg. We are 30 minutes into the trading day looking at equity indexes lower, the 10-year yield just slightly higher at 432. But I think really the story is the sell-off in tech continues. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. And coming up, Walmart in the red. The world's largest retailer misses profit expectations for the first time in 3 years.
Getting closer, the EU and the U.S. take steps to lower tariffs on many products, including cars.
And President Trump escalates his pressure campaign on the Fed as the annual Jackson Hole Symposium kicks off.
Let's kick it off, though, here on the program at 731 Lexington Avenue with initial jobless claims. We had those this morning, by the way, at 8:30. They came in at 235,000, a little bit more than we expected. Existing home sales have just come out at 4.101 million. That is a little bit higher than expected, a little bit higher than we got in the previous reading. So that's better than it had been anticipated. If you look at the month-over-month figure, it's a gain of 2%. We were looking for a drop of 0.3%.
Yeah, it's interesting. You don't see much reaction in the stock market. You did see yields maybe inch a little bit higher after we got this data. Definitely an indication that maybe we're starting to see some loosening in the housing market. And as Chris Verrone was talking about, that may be one of the things that the Fed is focused on. He said, watch the 2-year. We got the 10-year there, just yield up a little bit. The 2-year right now at 377.71, so also just up a tick. Let's turn to trade. The U.S. and the European Union have taken steps to formalize their trade pact. They're actually writing things down in detail, and that could reduce tariffs on products like cars as well as generic pharmaceuticals. The EU's trade commissioner spoke earlier in Brussels.
This is not the end. It's the beginning. This framework is the first step, one that can grow over time to cover more sectors, improve market access, and strengthen our economic ties even further.
Bloomberg Washington correspondent Tyler Kendall joins us now. So, Tyler, some incremental progress, it feels like, here, taking steps to formalize this pact. What kind of timeline are we looking at?
Right, that's exactly right, Katie. Well, we had been waiting for this joint statement here. At the end of the day, there's still a lot of unanswered questions, though this does get us forward a little bit, at least when it comes to the trading partners putting pen to paper. And there's still some things that need to be worked out. Of course, as you well know, there was a 15% tariff on EU exports, and that's already in place. But critically important, this extended to some sector-specific tariffs, including autos, when it comes to Europe. And this statement outlines that in order for Europe to secure that lower rate on autos, the EU must formally introduce legislation to eliminate a host of its own tariffs on U.S. industrial goods and expand market access for some of those key areas that this White House has been pushing for, including U.S. agriculture. So we can essentially think of it as a legislative trigger here to see that lower tariff rate when it comes to EU autos. But we did get some sort of a timeline, though it's a little murky. The statement says that that lower rate would be effective from the start of the same month that legislation is advanced. A U.S. official does tell us here at Bloomberg News that that could happen within the next month.
All right, Tyler, thanks very much. Tyler Kendall there in Washington, D.C. You can catch her probably throughout the day, but definitely at noon on Bloomberg Radio and 1 o'clock on Bloomberg Television as she anchors Balance of Power. Now, Charles Schwab, Chief Investment Strategist Liz Ann Sonders joins us now. And Liz Ann, we've had a little bit of a sell-off over the past few days. It seems to coincide with the risk of no rate cut rising. Are you concerned that the Fed at Jackson Hole may not signal that they're going back to cutting rates?
You know, Matt, I'd be surprised if Powell was explicit. This is a pre-planned speech. It's about the framework that the Fed operates under, and I think his formal comments will largely be about that, with any kind of signaling. That doesn't mean the attention is not going to be on that, but I do think it's the labor market that holds the key, notwithstanding the FOMC minutes that came out earlier this week that said at the time of the July meeting, there was more of a bias, other than the two dissenters, Waller and Bowman, there was more of a bias toward the inflation side of their mandate as a reason not to move. But that, of course, was in advance of the release of the July labor market report, which obviously was very weak. And I think even without inflation coming down to their target, if we were to see further weakening in the labor market, we didn't get great news out of the claims report today. I think that would be be enough of a trigger for the Fed to move. But I think at this point, 50 basis points is off the table, and that's clearly shown in the probabilities. And the probabilities of 25, to your point, are now down to 77% from close to 100 just a couple of weeks ago.
Absolutely. Over 100 at one point, I believe. But to your point, the odds of a 50 basis point cut happening next month, very, very slim. Lizanne, it's really interesting to hear you say that it's the labor market now that holds the key, because it feels like, okay, maybe we've heard some of the other Fed members acknowledge that that's what they're more focused on rather than inflation, but we haven't really strongly heard that from the chair himself.
We have not recently, but do keep in mind that as recently as last fall, when the Fed cut the Fed funds rate by 100 basis points and they launched with a 50, that was based on perceived weakness in the labor market. It wasn't exacerbated from there. And I think the bond market sent a message maybe to the Fed more broadly, given that the 10-year yield over the span of time that short rates went down by a percentage point, long rates went up by a percentage point. But that was just a year ago when the Fed essentially moved on rates and did so aggressively, based on much more on the labor market side of their mandate than on the inflation side.
Everything they do is really all about the consumer, right? I mean, they don't want to keep prices going up too much, and they don't want unemployment going up too much. That's the dual mandate. Seems to be maybe in tension right now. What are we learning, Lizanne, from the retailers that are reporting about consumer spending, about price increases due to these tariffs?
Kind of depends on the retailer, as we have seen. You've had kind of a mixed bag. I thought maybe one of the interesting set of comments came out of Home Depot because of some patting of themselves on the back a few months ago about the ability to sort of either take it in profit margins, but regardless, not have any significant plans to pass price increases along, and that tune change. Interestingly, the Walmart, you pointed out, it was the first miss in 3 years, but they cited things other than tariff-related pressures. So we're starting to get a little more meat on the bones in terms of the impact, but maybe reflective of the fact that this tariff story has been ongoing since April, and it's been fits and starts and announcements and delays and lowering of rates. That makes this a much more difficult and spread out process of trying to glean what the ultimate impact is. You're seeing it in a bifurcated way in the inflation data. You're hearing different things from different companies, some of which is a function of did they do a lot of front run ordering, building inventories at a low cost basis such that they bought themselves some time. So it's fine-tooth comb time to try to assess this as opposed to moment in time ability to do that.
Absolutely. It feels that way, that there's a lot of idiosyncratic stories out there. You can't just paint broadly here. I do want to get your perspective, Lizanne, on what is going on in the tech sector right now. The NASDAQ 100 down for what would be a third or fourth day. It's nursing its longest losing streak since March, though. And the question that keeps percolating is this something to be frightened of? Are we just seeing August trading, low liquidity, low volume, or is something more fundamental happening here?
Well, there may be some fundamental underpinnings that are not dissimilar to what happened in that mid-February to early April period of time, which memories tend to be short, but that was obviously the near bear market in the case of the S&P and an actual bear market in the case of the NASDAQ, albeit short-lived, with the move down largely driven by tech, comm services, the Magnificent Seven, that AI theme. And DeepSeek was kind of the one-off piece that was pointed to at that time, in addition to more general concerns about valuation excess, froth, just traders kind of getting to that exhaustion point. Now you maybe could point to that report out of MIT expressing concern about whether maybe there's a bit too much hype, and that is somewhat tied to the DeepSeek story, and that, was the massive spend likely to be something that continued? Did it represent truly this protective moat around the companies? And I think we just had a sentiment issue and a valuation issue, too, and we're just seeing this process of rotation. It's not abnormal. I actually think to some degree it's a bit healthy, because over the past year, only 20% of the S&P constituents have outperformed the index itself. Over the past 5 months, that's up to 40%. That's still a low number in an absolute sense, but improving. So rotation also provides opportunity to find interesting investments outside of just that concentration. So that's maybe a brighter way to look at some of this rotation narrative.
Yeah, an optimistic take on some of the sell-off that we're seeing now. Liz Ann, always great to speak with you. That is Charles Schwab, Chief Investment Strategist, Liz Ann Sonders. And I just want to point out, Matt Miller, that on the S&P 500, it's falling for a fifth straight day. That's the longest losing streak since January. So maybe contained overall when it comes to the individual day moves, but it's starting to add up.
That's pretty impressive stat, considering that we're already, getting close to the end of August, the end of the third quarter almost. So the longest losing streak all year. Let's get a look at some of the single stocks that are moving at this hour, because there's a lot more going on, I think, under the surface than at the index level.
Yeah.
Walmart shares, to me, are pretty impressively falling after missing expectations, and as Andrea Felstead told us, reaffirming their sales forecast, raising it even, but not raising their profit forecast. So it looks like margins are going to get hit. They did say in terms of the reporting quarter, they had a rise in insurance claims, legal charges, and restructuring, and that's part of the problem. Part of the reason that Walmart missed for the first time since, I think, May of 2022.
Yeah, those costs definitely taking investors by surprise. Let's take a look at Boeing, heading closer towards finalizing that deal with China to sell as many as 500 aircraft. That is according to people familiar with the matter. We know that there's some strings there. It depends on the U.S.-China relationship, so a muted gain in Boeing right now.
Coty forecasts steep sales declines and reported a wider than expected loss for the fourth quarter. The perfume maker losing almost a fifth of its total market cap. Coming up, we're live from Jackson Hole, Wyoming, as pressure builds on the Fed. This is Bloomberg Open Interest.
I think that's where you're seeing a lot of the debate now is, where's your lean? Is it where, do you believe things are too restrictive on the policy rate side or not? I think they're modestly restrictive. I'm still trying to find ways of what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
That was Kansas City Fed President Jeff Schmidt speaking with Bloomberg earlier on the sidelines of the Jackson Hole Symposium. Bloomberg surveillance co-host Lisa Abramowitz joins us now from Jackson Hole. And Lisa, we were just speaking with Liz Ann Sonders. Her opinion is that it's the labor market that's key to the Fed's decision making right now. But I have to imagine that's going to be the hot topic of conversation. Which side of the dual mandate is more urgent?
Especially given, Katie, that we got yesterday the meeting minutes from the last Fed meeting that pointed to the concern over inflation. Remember that core PCE has been above 2% since 2021. A real question here about how much the Fed plans to emphasize getting it down in short order and keeping it there at a time when the data today really highlights the conundrum that the Fed is in. On one hand, you have ongoing jobless claims continuing to grind higher to the highest level since 2021. On the other hand, you see from the S&P Global Flash PMIs a real pricing pressure lifting up the sense for manufacturers that they're going to have to pay more in the future. This is all what the Fed would be talking about, but also on the side, there is this sort of drumbeat, at least off the record, from former policymakers, current policymakers around the world. How does an institution deal with making policy at a time when they feel like they are under assault? And that is sort of the feeling that there is here in Jackson Hole.
All right, Lisa, thanks very much. Bloomberg's Lisa Abramowitz reporting live from Jackson Hole, Wyoming. Don't miss her special coverage. Jackson Hole surveillance kicking off tomorrow at 9 a.m. Eastern. Lisa will be out there joined by TK.
Yeah, I'm excited.
He's going out there as well. Tom Keene will be with Lisa at the Jackson Hole Symposium. Joining us now is Julia Coronado, a former Fed economist who now runs Macropolicy Perspectives. And Julia, we've been talking the last couple days about, or yesterday and today, I guess, about the pressure put on Lisa Cook by Bill Pulte and Donald Trump as well. You think that what he wants to do is he's got two appointees already on the FRB. Now he has Stephen Myron, whom he could get confirmed sooner than September. And then maybe get Lisa Cook out of the way so that he has 4 of the 7 seats, right?
Yeah, I mean, it seems like a pretty transparent political attempt to take control of Fed policymaking. And that is probably intended both to influence the setting of interest rates. So it's very clear Trump wants lower interest rates. He says it every day, just about. But also to influence the structure of the FOMC. All of the Reserve Bank presidents are up for renomination in February. It's usually a pretty standard process handled at the regional level and then sort of just rubber stamped by the Federal Reserve Board. But they do have veto power. And if they have a majority on the Federal Reserve Board, they may be able to influence not just governors, but Federal Reserve Bank presidents at the district level. And that would be certainly a new level of intervention and pressure and politicization of the Fed.
And do you think Waller and Bowman would play along there?
That's an open question. I mean, they are Trump appointees, and they have certainly aligned their views on interest rate policy with his desire for lower rates. Certainly not in any kind of incredible or not credible way. They have their internal logic. It's supported by the data. So it's not clear to me whether they will go along with this. But I think it's, not out of the realm of possibility that they would. And certainly that's the intent, is to, whether it's building renovations or Lisa Cook's mortgages, these are pretty flimsy basis to go after a vetted and seasoned policymaker, and pretty transparent but repeated and persistent attempts to take control of monetary policy at the executive branch level.
Well, Julia, let's look ahead to May 2026, when we do see another Trump appointee come into the Fed chairperson role. We were speaking with Sarah Wolf of Morgan Stanley yesterday, and she said, okay, should that happen and you do see rates drop dramatically, those rate cuts aren't free. Basically, you would have to pay for them in some other area of the economy. And I'd love to hear your thoughts on that.
Yes, well, we've seen this before. This is a playbook that has been repeated across countries and even in the US in the 70s. If you set interest rates at an inappropriately low level for the economy, what you tend to get is inflation. What you tend to get is risk premia built into that yield curve so that longer rates may actually rise if the Fed tries to set short-term interest rates inappropriately low. So we could see further devaluation of the dollar. We can see inflation pressures arise. It may not be from one day to the next. It's a creeping thing that happens over time. The macro economy is an ocean liner. So this dial, they turn the dial, and it will take time for that to build. But again, it's pretty clear. We've got extensive experience. We have to view the independence of the Fed and the independence of central banks globally as an evolution. There's a reason we created this barrier between politics and monetary policy, because it results in greater stability for the economy, better outcomes. Breaking down that barrier is pretty, predictably going to lead to worse trade-offs, higher inflation, and potentially even higher longer-term mortgage rates and borrowing rates for households and businesses in the economy. So no, there's no free lunch. Things do have to add up at the end of the day. So again, we've learned that lesson before, but it seems like the president has not learned those lessons of history and is putting a lot of pressure on the Fed to make decisions not based on the data, not based on the reality of the economy.
Julia, if I type in TAYLGO on my Bloomberg terminal, looking at the Taylor rule, plugging in like 3.5% for a neutral rate, 4% for full employment, I'm still getting a much higher estimate for where the Fed should be right now. And if I look at it from a market's perspective, right, we're at all-time highs in the stock market. Bitcoin's at $125,000. We're at 4.2% for unemployment. Profit growth is like 10%. So, like, how restrictive are they right now? Are they really restrictive? They need to cut as inflation is rising again?
You know, that's a great set of realities that the Fed is having to sift through. It's not clear where neutral is. The debate on the committee, the discussion on the committee over the last year to 2 years has been, where is neutral, given how well the economy is performing and financial markets. And financial markets tightened in April on the trade shock, but then they've really eased since then. And there's a lot of mixed messages. It is true that the underlying labor market details don't look great. They look vulnerable. They look subject to downside risks. On the other hand, inflation has been above their target for 4.5 years, and it looks sticky. The last inflation report wasn't all about tariff inflation. We actually saw a rebound in services inflation. So inflation has been sticky and stuck above their target, and not just a couple of basis points, but we're closer to 3 than to 2.
Right.
And that's not exactly where they want to be. And stock market's close to the highs. Yes, it's been squishy in the last week, but it doesn't look like the financial conditions are restricting the economy.
Julia, unfortunately, we're up against the clock. Have to leave it there. Really appreciate your insights. That is Julia Coronado. She is former Fed economist and president and founder of Macropolicy Perspectives. This is Open Interest.
The boating industry is crashing back to earth after rocketing sales and profits during the COVID pandemic. But shares in Brunswick, the biggest recreational boat maker in the world, have outperformed all of its U.S. peers over the past 5 years. And analysts have been raising price targets on the stock since its second quarter earnings report in July. Joining us now to talk about the outlook for his Sea Ray and Boston Whaler boats is Dave Foulkes, the CEO of Brunswick. Dave, great to have you on the program. Let's talk about your outlook, because it looks like we've kind of bottomed out here. We've run aground, but hopefully we're going to ride the waves back up in the coming years. Is that how it looks to you?
I think it does. Well, first of all, thank you for having me. And I think that was reflected, as you said, in our second quarter earnings. Revenue up year over year, revenue and earnings well ahead of guidance. $250 million of free cash flow. So we were extremely pleased with that performance. I would say, as you mentioned, we've been through a cycle, but it hasn't been a uniform cycle. Our premium brands, Mercury Marine, you mentioned Sea Ray, Boston Whaler, and our core brands have held up extremely well. Where we've seen a bit more pressure is in the value part of our portfolio, where people are a little bit more influenced by, for example, retail interest rates. But overall, we definitely see good sentiment and good demand, particularly in the premium and core parts of our business.
What kind of benefits do you get from being the biggest? I was looking at the RV screen on the Bloomberg relative value, and you pretty much tower over your competition. You have a market cap of more than $4 billion. By a large margin, you sell the most recreational boats by unit. Everybody knows your brands are household names. Bayliner, Crestliner, Lowe are some of the others, and there are more and more. I think you have half of the outboard engine market with Mercury. So
we do.
What kind of benefits do you get from that scale, Dave?
Well, a lot of different benefits. For example, we're really in our own ecosystem, if you like. We have a lot of internal sales to and from different parts of our business. Our Mercury outboard engines, for example, you mentioned, get sold to our Sea Ray and Boston Whaler and Bayliner and other brands. We also have Freedom Boat Club, which is our subscription boating model that takes engines and boats from our own businesses and puts them into that model. So really a lot of ecosystem benefits. But scale, helps with pretty much everything. It helps us in negotiations. It helps us with absorption. It helps us be resilient. One of the important things that differentiates our business versus some others in the leisure and recreation sector is our earnings power in our recurring revenue businesses. We have very large parts and accessories, aftermarket, repower, and subscription businesses that actually account for about 60% of our earnings. And they are really not as indexed to the new boat market as our new boat sales, for example, but depend more on boating participation. And actually, interestingly, even though new boat sales have declined since COVID, boating participation is actually up. So if people have a boat, they are using it, they're enjoying it. I was on a lake on Saturday and Sunday last weekend. You could see plenty of people out there enjoying what has become, pretty nice weather in the late part of the summer. So if they're using it, they're generating a need for P&A. They're using their Freedom Boat Club, for example. So we're excited about that participation part of our business.
So boating participation rates still expanding healthily there. I do want to talk, Dave, about what you said on your July 24th conference call. You mentioned that retail conditions, they had improved in July versus the early part of the year, but has that continued? It's an uneven economy out there. Of course, I feel like the boating community is pretty motivated, but even still, have you been able to build on that momentum?
Yes, we have. Since July, really, conditions have improved. And I think a number of things have stabilized. I think sentiment and confidence has stabilized since probably early April overall. Obviously, we've seen the equity market rebound significantly. So I think people are just feeling somewhat more confident. And that has particularly come through, as I mentioned, in the premium and core parts of our market. In the value part of the market, there's still the relatively high interest rates are still a bit of a deterrent, keeping some people on the sidelines. But we're doing everything we can to overcome that with promotions, for example, and it's beginning to work. So overall, I'm pleased with the overall trajectory of the year at the moment.
I know you make most of your product in the U.S., Dave, but I wonder how tariffs impact you. We've heard from automakers like Ford, they make most of their product in the U.S. as well, but they're still paying tariffs on the steel and the aluminum. They import, obviously, auto parts. They get magnets from China. You have to use all that stuff, too. How is it affecting your margins?
Yeah, so you're exactly right. We make about 75% of all the products we make in the U.S. About 70% of our supply chain is in the U.S. We have operations in more than 20 states. So we're very much a U.S. manufacturer, but we certainly do have a global supply chain. We're exposed, about 4 to 5% of our suppliers from China, and obviously we're paying tariffs on that. In our earnings material, we really talked about tariffs in 4 different ways. We talked about our exposure, which we're working down over time. About 4 to 5% of exposure we have right now is probably going to be about 2% by the end of next year. We talked about the actions that we're taking to mitigate the tariffs, which we're being very effective at. We talked a bit about the effect of the initial tariff announcements on demand, which has since alleviated, as I mentioned. But the other thing we talked about is the fact that we really are the only domestic manufacturer, particularly of outboard engines. And we do have very high market share in the high 40s to 50%. Our competitors are Japanese. And so in the long term, we feel that we're kind of foundationally well positioned in an environment of more persistent tariffs. In the meantime, in the interim, though, we're doing everything we can to reduce our exposure in a lot of different ways, a lot of smart ways, I think. And our organization is being very effective.
Hey, Dave, just one question on the kind of boats you make. And as you said, you dominate in market share, the classes in which you play. But we were talking with Steve Minetto from Malibu last week, and they rule the roost when it comes to inboard, wakeboard towing boats, water ski towing boats. Why don't you play in that sector?
We do a little. We have a business called Heyday, which plays in the value part of that sector. But if you think about the overall boating market in the U.S. being something in the range of 150,000 to 200,000 powerboats every year, the tow market is quite small. It's only about 10,000 units. And so obviously Mercury plays a little in that space, but it is not a space that we're heavily indexed to. Interestingly, we did buy Flight, which is an e-foil company, that does electric surfing, electric surfboards, if you like, electric foiling surfboards, which is an exciting way to go surfing without the need for a surf boat. So, we're finding, I think, smart ways to give people what they want in on-water experiences without necessarily having to be the OEM in every segment.
All right, very cool business, Dave. Stop by the studio next time you're in New York City. Dave Foulkes there of Brunswick, the biggest recreational boat maker in the world.
Yeah, and I know that you're a big boat guy, so.
Well, it's just, I spend some time on lakes too, and you see those pontoon boats, you see those water ski boats. Yeah. It's just a great way to spend your summer.
Yeah, no, I get that. I like to stay on land, have my feet on the ground at all times, but I'm happy for you. Let's take a look at the market right now. We're just over an hour into the U.S. trading day, and losses lessening on the S&P 500. You're still looking at a fifth straight day of losses, but we'll see if we can get into the green by 4 p.m. The S&P 500 currently off by about 0.2%. We were down by as much as 0.6% earlier, so some breadth improvement helping to boost the market a little bit, but still red. And then you take a look at the 10-year yield, higher by about 3 basis points. Quiet overall, Matt. We're just hanging out around 4.30 on the 10-year.
Let's take a look at some of the single stocks moving at this hour. You have Cracker Barrel shares extending declines for a fifth day amid a wave of negative social media posts surrounding a recently unveiled change to the company's logo. I was just in a Cracker Barrel.
I love Cracker Barrel.
It was lovely.
Yeah, no, it's great.
Kids loved it.
They took the man with the barrel out of the logo, I believe, is the big controversy.
That's the big deal?
Yeah, I mean, it's a little bit soulless. Anyway, Meta also down. Meta freezing hiring for its AI division after spending hundreds of millions of dollars to hire talent for its super intelligence ambitions. It announced a shakeup to the AI org chart earlier this week, shares continuing to fall.
And we've been reporting all week about the Dayforce sale. It's now official. Thoma Bravo will buy HR software provider Dayforce for $12.3 billion. I believe we're going to have an interview with the managing partner of Thoma Bravo in the next hour.
11:10 a.m., I believe, is the rough time.
Holger Spott.
Holden.
Holden. Sorry, I was trying to remember. I'm usually pretty good with the German names. Coming up, Walmart falling after posting a rare profit miss. We'll speak to the analyst Oliver Chen of TD Cowen next. This is Bloomberg Open Interest.
Let's take another look at the world's largest retailer because shares of Walmart falling after profit missed expectations for the first time in 3 years, overshadowing higher sales and also a boost to full-year guidance. Let's dig a little bit deeper now with Oliver Chen. He is senior equity research analyst over at TD Cowen. He has a buy rating on the stock. Oliver, great to have you with us. It's not often that we see a boost to the outlook, but still shares decline. So give us a little bit of context how you're thinking through some of the surprise costs that caused profit to miss expectations here.
Katie, what we are excited about is that the comp store sales were better than we expected. However, as you mentioned, it's been mixed in terms of the gross margin in the SG&A being lighter than analysts expected. That being said, it is mixed in that they raised guidance. We like Walmart for the long term. We were cautiously optimistic into this print, in part because the PE ratio is at 37 times, and this company is executing on all cylinders. What's really impressive to us for the long term is also a lot of digital enablement, specifically e-commerce growing at 25%, and also their advertising business growing above 40%. Digital advertising. Those are very great attributes, and you marry that with a grocery business focused on value, those are great things for the long term. Today, the print in the stock has been mixed, in part because valuation was high, in part because analysts had estimated margins would be better.
I wonder about the grocery competition from Amazon, for one thing. It doesn't seem like it would take a huge dent out of Walmart sales, but a lot of Walmarts seem to be situated next to actual grocery stores. And does that hurt them at all?
Yeah, Walmart's grocery is outstanding just because they're the #1 market share leader. Also, this company has been really focused on value, pricing, rollbacks, increasing the amount of items on rollback, which has all been great for the customer. Inflation has been up about 1% to 2%. The future continues to be very competitive, Matt, in terms of Amazon and grocery. But we think Walmart has the winning formula, in part because you marry physical meets digital. And Walmart has 4,000 stores, 90% of America within 10 miles of Walmart. And what we see, Matt, is customers using many ways to receive groceries, including fast delivery, including curbside pickup, including buy online pickups in store. And then also AI, using AI for checkout and computer vision. And also they have a new tool called Sparky, which is their LLM model too. So these are all attributes, but grocery is a hard, low margin business. As we think thematically, Matt, it's about needs plus wants in the future of retail, meaning a great food business as well as discretionary. You can really do that through a marketplace model.
Well, across the different business lines, what does pricing power look like for Walmart right now? For example, we heard from Home Depot earlier in the week, basically saying that prices are going to rise in a couple months' time. What does that look like when it comes to Walmart?
Yeah, what we've seen this quarter is prices rising by about 1% to 2%. At the same time, as prices have gone up, the unit sales have gone down. So management teams are paying a ton of attention to elasticity. What's nice about this print also is Walmart's general merchandise was positive low single digits. That bodes really well because that's been a bumpy ride in general merchandise. I think what you're going to see going forward, Katie, is this continued pressure on the low and middle income. Also a consumer that has money and spending power, given unemployment is low and there's $1 trillion on the sidelines, but a consumer that's very anxious and delaying and being choiceful and looking for value. The other value stock ideas we like include Costco and BJ's, but that's a theme we'll continue to see. And this anxious consumer is a theme. What shoppers have been doing, Katie, is shopping earlier, and they do expect higher prices. So there is anxiety here, and interest rates is something we're watching too.
Well, we'll definitely be watching that here on Bloomberg, especially tomorrow as Jerome Powell speaks at Jackson Hole. I wonder about the employee base. I mean, Walmart is by far the biggest retailer in the world. They have at least 2.1 million employees. Does that dwindle over time with AI, with robotics, or is this the kind of business where you just need that kind of manpower?
Well, as you think about Walmart, there's a real trust factor. I grew up in Louisiana, going to the Supercenter daily. So as you think about Walmart and the communities, there's a trust and people factor. A tech-enabled, people-led, as we think about what's going to happen next, and really repurposing people and labor to offer more service to customers. You have to offer both, and AI will be very human as well. You know, when we think about AI, we think about HIDL, human in the loop, and reinterpreting AI to service customers through people as well. So I think there'll be major repurposement, especially as we think about distribution centers and tons of efficiency in labor, merchandise margins, as well as labor and inventory management. Those will be key themes, but everybody's changing the way they work. And as we think about customer associates, a lot of AI tools are helping them be better customer associates through store navigation, through helping customers find items, and through offering, more human interaction. So we'll see a little bit of both. They hired a new AI officer as well. So there's a lot to come. And I think this will be a society question too, in terms of trust and ethical models and geopolitics as we think about AI in the future.
And Oliver, before we let you go, I do want to talk a little bit about Target, of course, getting punished earlier in the week. When it comes to their earnings, also their C-suite news that they had named Michael Fidelki as their next CEO. I know that this is a company that you have a hold rating on. How much confidence do you have in Fidelki to be able to right the ship here?
Yeah, we want Target to win. There's a lot of work to be done. Michael knows there's a big sense of urgency. He's going to have to lean into what made Target Target and design and style, as well as convenience, as well as technology. So Target knows what it needs to do. The harder part is execution and speed, and also changing the way people work for this way too. We'll see. What's good about Michael is he's been with the organization for a long time, meaning a lot of these cultural changes will potentially be easier for him to make, and he knows the pros and cons. What investors were looking for is probably somebody from the outside to be a stronger catalyst for change. But as you know, that carries risk too. We want Target to win. We're waiting to see what will happen. Bottom line, their comps are negative. Walmart's running positive, and Walmart has a head start, a lot further along with the marketplace model, as well as digital advertising. Walmart's numbers on e-commerce were up 25%, and they were only up about 4% at Target, in part because Walmart keeps on adding products to its marketplace catalog.
Oliver, great to get some detail with you. Oliver Chen there of TD Cowen talking to us about Walmart earnings as well as comparisons to Target. Coming up, FanDuel expanding from the gridiron to Wall Street. We'll bring you the details next. This is Bloomberg Open Interest. Sports betting company FanDuel is teaming up with the Chicago Mercantile Exchange. The partnership will allow users to make bets on stocks, commodity prices, and even inflation data. The news comes the same week as Robinhood announced plans to add football contracts to its prediction markets. Joining us now is Bloomberg Markets anchor Scarlett Fu. So everything's kind of melting together, right?
Yeah.
The trading floor and the casino are becoming one finally for actual real.
Worlds are colliding, lines are being blurred. You now have FanDuel offering stocks trades, index trades, currency trades through the CME. You have Robinhood now offering sports betting or sports contracts. And this all comes, of course, after sports and financial markets kind of saw a merging of the mind during the pandemic, right? Live sports were suspended when COVID hit, so a lot of sports fans turned to markets, and that led to a lot of day trading, that led to the meme stock craze, that led to individual investors using options, and now you're seeing a lot of demand for it, and we have a regulatory environment that's supportive of this.
Well, let's talk about that. Supportive of it in the sense that they haven't found a way to say no yet, it feels like.
Or maybe they don't want to say no. It's not really clear what whether they're going to come in and say no. What we can tell you about the CME and FanDuel partnership is that these are products that will be regulated. They will be listed on CME exchanges. They will be subject to CME rules, and this is all pending review by the CME's regulator, the CFTC.
All right, so what are the regulatory issues with this? Because obviously betting on stocks, investing in stocks has been allowed
also betting on stocks
for a long time. But that's the issue, right? It's the betting part that's the problem. Gambling.
Well, this is now an existential debate. Is this gambling or is this investing or trading? But what we can tell you is that in terms of these trades, these are event-based contracts with what they call defined risk. So what it means is that you can bet on the outcome of events. For FanDuel users, it's betting on market events. You can bet on the jobs report. You can bet on CPI. You can bet on whether Bitcoin will hit 50, 100,000 zillion dollars.
A gazillion dollars.
Yeah, exactly. And maybe that's a bet on there.
It can become addictive.
Yeah,
maybe.
That's
but as much as anything
concerns.
else, they see the demand out there for this kind of product, and it's a way for these marketplaces, whether you're FanDuel, whether you're Robinhood, to make sure that users stay within their ecosystem. You offer them a one-stop shop because if they are interested in betting on sports or wagering on events in sports, then you offer them a place to do it in your ecosystem, so they don't have to venture far. They don't have to set up an account somewhere else.
All right. Cool.
Are you guys going to be betting on sports now through your Robinhood accounts?
No.
Probably not.
Definitely not.
I like to keep it pure. But
are you going to be betting on the S&P 500 through your FanDuel accounts?
I always lose money when I bet.
Passive index tracking fund, perhaps. Scarlett Fu, great roundup.
All right, coming up tomorrow, don't miss our Jackson Hole special. Jackson Hole Surveillance kicks off at 9 a.m. Eastern. Tom Keene and Lisa Abramowitz, joined by Boston Fed President Susan Collins.